Hey, Dave Knott here at 123daytrade.com. Thanks for watching. Thanks for being here. Today is Friday, November 2nd, 2018. I want to bring to your attention something really quickly that I've noticed in uh, trading over the years of watching the crude oil market, and something that if I had the BALLS to reverse at this point, hindsight, it's beautiful. And the Friday tendency is the market, without any real direction, to hit both its lows and its highs. Now, the low I believe the low at the time of trade was around 20 something, 63.20 something. I have to look back and see where it was. Let's pull the 15-minute. This is the hourly chart, so this will be good enough. So our lows were right around here. 63.26 it looks like. All right. So the market has a tendency to hit its highs and its lows. So it was about a 50 tick range, 60 tick range at the, what was that, 95 to, well, I can't even count right now. Is that 70 ticks? All right, so that's really not the important part. The important part is, let's call it 25. So it was a 70 tick range. So the important part that I want to show on this video, and I don't even know if you can even see it. If you would see where's the turning point, we can see where the turning point is, right? So let's get the screen draw tool out, and you see that this right here is that turning point. Now, if we look over here to the left in just a minute, we're going to see that it was. And then we're going to look at this bar right here, and you're going to say, why is that significant? So why is this a significant point to turn the trade to go this way? And for some strange reason, it works on the reverse as well. When you see this on the tick chart, a lot of times what you'll see is something very similar working the other way, just like you see this one working. Now, why does it work and how does it work? Why? I guess the question that you need to ask yourself is why? Why is this showing like this, and why is that end up being the temporary bottom of the trade session and then it goes up? And if you can see that, where would you want to be long from? Now, I would argue that being long would be somewhere above the 200 bar line in a down move. I've usually consider that right there. Now, as far as my trade exit on the day, I got 24 ticks on the trade session, and I'm going to talk about the trade setup that I have. Now, on a Friday, what I look at normally on a Friday, let's go back to highest volume bar. Now, this is highest volume bar in the trading session, 1379 or whatever that is, 1428. This is highest volume bar when the trade session opens up. It comes in at 711. If you go look to your left, you won't see anything higher than this bar. Now, the tendency of the market to sell off early on a Friday is what I take advantage of. Plus, more importantly, where are we trading at the early part of the morning session? This is my sweet spot, pivot point to S1. So this pivot point to S1, I have a tendency of wanting the market, the tendency of the market when it's trading between pivot and S1 is to sell off early. Likewise, if it's trading above pivot to R1, it has a tendency maybe to go up to the highs first and then sell off on a Friday. But right now, what you see on a day like today, the tendency of the sweet spot that I like is pivot point to S1. If you followed any of my work, you know that this is the sweet spot of trading that I like to trade. Pivot point to S1. In other words, where's the market trading at time of trade? So we got to look at, I like to look at the 8 o'clock mark, right? So you see this bar come in here at 8:05. I'm already short coming into this. my original entry point before at the 8 o'clock mark was right here, 63.37. If I'm not mistaken, I believe that's where I got it involved. I got involved at 63.47 right in here. So hopefully you can see what I'm looking at here. The reason I got involved in this fake out was the lower high pattern. I was just taking advantage of what I saw in front of me. Lower highs coming through here. Now it could have failed and went up, and I was risking 11 ticks at the time. So that was my trade. So I was looking at 11 ticks and ended up getting 24. So that's not a bad trade setup as an overall. So you can look at that. I was risking 11 to get 24 at that point. Obviously, I wanted the market to continue to move down, but it decided that it wanted to stop. So this bar comes across the charts, and we use a fake out to get involved. Well, actually, that's 7-11. So this right here is our fake out. So what I do is I use the low of the move, and then I come in 2 ticks underneath it. So my entry point on the trade is right here. And the tendency of the market to sell off into the open of the 8 o'clock mark, because we're trading, once again, where are we trading? We're trading the pivot point to S1. So I'm looking for the market to make a run to S1, and we'll look and see how close it got there in just a few minutes. So this line right there that you see is 1P. So that was a 1P move down, and therefore it gave you at least a break-even trade at that point in time. What I like to do, though, when I'm trading is I know that this right here is the highest volume bar, and it's on the red. So what I'm expecting is the market to rebound and come up at some point. And that some point is right in here. Now we look at this now, and the significance of it is this is all by itself, and it's opposite color of what the market normally shows. So normally when you see these lows down here, you'll see a red bar like this. Now the significance of this is that when you see the reverse color on the down, this can be, a lot of times you'll find it being, if nothing else, a temporary low in the market. And what I did is when I saw this, I moved a little above the 200 bar line. I said, where do I want to protect my profit? And what I did is I looked at where the 200 bar line was in relation to when I saw this bar, and then that's how I protected this trade. So if we go over and look at right edge now, you can see that I was run out right in here. Now this mark up here would have been the trailer if I would have trailed 2. And how did I measure that? Well, I look at the low, I go up here, and I add 10 ticks. So it was 26 plus 10 is 36. So both sides of the trade would have been out on this particular trade on the short side. So if you look at it another way, we were in at 47. I guess if you would have been Johnny on the spot, and if I trusted the signal itself, you would have got out on one way down here, and then the second one would have been here getting out. So I don't know why. I mean, this is just an observation as a guy that's watched the markets for when we talked about November of when I that first was it February of 2007 when I made my first blog post or first journal entry. So I've been watching the crude oil market since around that time, February of 2007. So and now we're in what, 18, almost 19. So let's just say 10 years, because I don't want to do the math right now. My brain hurts. So What I can tell you is that the longer I watch the crude oil market, these little blips that come across the market like this, they have a significance. Now, I don't know what the significance is, and maybe someone smarter than me can let me know down below in the comments section why that mark right there is significant compared to this mark right here, which is highest volume bar. Now, highest volume bar in the reds has a tendency to sell off a little bit more until it finds a bottom. So that's why I don't like getting involved in the longs a lot of times. Where would I have found interest in a long would have been above the 200 bar line. I was already short coming into this trade, and I got out right in his area on my short side. So the trade itself did not last very long. This was the entry point right here, and here was your exit. So if you look at time in trade to make 200 bucks, that's called 240. So 8:01 or 8 o'clock to 8:19. So what is that? Let's just say 20 minutes. So 20 minutes for 240 bucks. That's how quick that you can make money on the short side of the market. And if it wanted to continue to move, I would argue that this point right here, we didn't need to, and you could see it attempted up through here to start with, and it tried to break down here. It's getting too many lines. So when I looked at here, I looked here, and I looked here. And I said, all right, this looks like a good spot right there. And it's all in a matter of the beholder, right? I looked at this up here. I said, well, if it moves up to here, if it moves up to this break point up here, it's most likely going to go this way. So I want to be somewhere in between, and this is 1P. So I quickly looked, and I didn't have a lot of time to think about this. It's 8:15 right here, and it runs you out at 3 minutes later. So you had to look quickly to try to figure out a spot that you'd be comfortable with getting out of the market. You could say, oh, it looks like a double bottom. Well, yeah, in hindsight, it looks like a double bottom. You see this red bar and this highest volume bar there, and then you see this blue bar right here. The point is, this is an anomaly. So let's call it what it is. I don't know how to spell anomaly. I think that's how you spell it. This is an anomaly. In other words, it's something that's out of the ordinary. So that is a significant point. Why? Your guess is as good as mine. But what I'm going to tell you, this anomaly, more times than not, can form, in this case, a temporary bottom. Doesn't mean it'll be the low on the day. It just means that, hey, this is an anomaly. You need to protect profits at this point. Now, this would have been the trade exit on both contracts, or both series, in my humble opinion, on the trade. But the point is, the first series of contracts, you might have been able to knock it out right down here once you saw this come across, or at least get up through here. So I got about as much profit as I could on this particular trade. So it's a one trade win for me for 24 ticks. It's not a bad trade. I didn't catch the move yesterday. That's not what I want to move over. Yeah, I guess I'll move that over. So this right here is the practice account. I've been goofing with it over the years. But this is where I stand on 2 days of trading. I'm up, what, 28? I think I was up 6 and then 24. I'm around up 30 ticks on the overall as a trader right now on 2 days. I missed the movement in the afternoon yesterday. I gave up on the market about a half an hour before it sold off. It looked like it was doing nothing, and then the market sold off. And I don't really have a reason behind why it sold off. It just did. It was just one of those things. I don't want to confuse yesterday with today. I just want to talk about being in the zone of where I'm comfortable at trading. and this was a comfortable trade for me to take. Taking on as a review, it was a lower high pattern. We were trading in the S1, the pivot point to S1, and I was looking for the mark to move to S1. Now, this ends up being the low right now, and S1 is down here. Now, this was 2P move right here based upon entry point, and this was a 3P move right in this area right here if it would have went. Was it 60? I think it was right in here at 67. Yeah, 67. So this was a 3P move. If it would have went, this was what I was looking for. I was looking for the market to run about 62, 67, a 3P move from entry point. So that was the target that I was looking for at the time. But recognizing that when this anomaly came across the charts, something was not jiving with the other. So I hope this helps. It's a lot of talk about just what you see in the market, right? And you can see that this is the bottom right now. That's the low, and it's been trading up ever since this little blue bar comes across the lines. And like I said, it doesn't mean that this is going to be the low of the day, but most likely what it wants to do right now is test the highs. So on a Friday, and today's employment day though, I believe, right? So on a day like today, let's double check that. And that's how important the unemployment numbers are in the crude oil market. They're not important. They're not important. So 7:30, it came out. Non-farm and average hourly earnings. These numbers right here are not normally important to the crude oil market. So therefore, I don't really worry about them too much, and I still wait for the 8 o'clock Central Standard Time to start my trading in the U.S. markets. And see what I set up to start with, 205 versus 15. This was a 7P target, by the way, 205, and 15 was a 2/3 stop. I quickly moved to 11 after the 15 was marked, and it went down initially. I went down to 11 ticks. So I went to 1/2 hour stop. I went actually 12 ticks. I keep saying 11, but I moved from 15 down to 12, 1/2 hour. And then when we moved down underneath there, I was at break even. And then when we saw that blue bar that I showed on this particular video, that's where I moved down to the blue line, the 200 bar blue line, and took as much profit as I could right now on this trade sequence setup. Like I said, if I had the balls to reverse right here, hindsight's always a winner. So I'm going to caution you against, just because you see this, to just trade it. I mean, I would tell you to have further evidence, but what I'm telling you is my experience has told me over the times when you see an anomaly, that can be, and it works the other way too, when you see an anomaly on the long side and you see a red bar coming across, and this is actually how I found it to start with. The anomaly was on the other side. So if you would stand on your head, and this would have been the high, and this would have been a red bar, because you would have had all blues coming through here, and then you just had this anomalous red bar come across, and this would be, you're standing on your head now, so this is the high of the market. This is where I felt comfortable about selling the market into this mark if I wasn't into a trade. So I was into the trade, I was in the short, but this would have been a nice mark to go and take it to the other side. So I mean, right now you would say, all right, the market's going to go to at least 63.95 and run the highs. So 63.95. So this could be on the other side, could be worth at least 95 ticks the other side of the market once you would find the low. I'm not comfortable trading down on the lows though, but for some strange reason I'm very comfortable trading against the highs. And the reason that I like to trade against the highs is I know the market will fall a lot quicker than it'll go up, more times than not. All right, 20 minutes of talking. Let's get going. Hope you had a great week as well. November has treated me so far so good. I'm following my trade signals. I took the trade signals I agreed to yesterday. I was only able to get 6 ticks out of the market, and today I was able to get 24, following the trades that I wanted to take. Um, Maybe as time moves on, this will be a trade setup that I'd be a little bit more comfortable at taking. I mean, I know I'm very comfortable at taking the short side of this. So if you're standing on your head and this was the reverse of what this is, now that would have been a beautiful area to reverse and go the other way. Talk to you later. Bye for now. Let me re-say that. It's Dave Knight here from 123daytrade.com. Thank you for watching. Thank you for being here. We'll talk to you on the next video I put together. Bye for now.